Global silver markets are showing signs of significant stress today, as a widening gap between Eastern and Western prices, declining vault inventories, and a brief trading halt on a major commodities exchange converge into what analysts are calling a rare confluence of physical market pressures. This is a financial education report. Nothing in this broadcast constitutes investment advice or a call to action. Here are the key figures at the center of today's report. Western spot silver was recorded at $93.75 at the time of this report, with futures prices closely aligned. Meanwhile, the Shanghai Gold Exchange spot benchmark closed at $105.34. That difference, ranging between $11.59 to $12.40 per ounce, represents the widest east-west price premium observed in several months. Observers note that this spread is sufficient to cover shipping, insurance, value-added tax, and related costs, while still leaving a meaningful margin for those capable of physically moving metal from Western markets to Shanghai. Adding to the picture, COMEX registered silver inventories printed at 86,130,399 ounces on the same day, a figure described as a modern-era low. Approximately 2.3 million ounces were withdrawn from the registered category within the prior 48 hours alone. Also on this date, CME Globex experienced a technical issue that temporarily froze metals trading during a price surge past $91 per ounce. During that halt, 31,828 silver contracts, representing approximately 159 million notional ounces, were processed and settled. Markets reopened and prices pulled back shortly after. Beginning with the Western spot market, silver reached an intraday high of $93.80, representing a gain of more than $5.50 on the session, or over 6%. That move is being characterized as a significant single-session price event within the paper futures market. At the same time, the Shanghai Gold Exchange spot benchmark was recorded at $105.34. The report emphasizes that this figure reflects the price being paid by actual buyers in China, including recyclers, industrial consumers, exchange-traded fund purchasers, and sovereign entities, for physical silver ounces. The resulting east-west dollar premium, measured at between $11.59 and $12.40 per ounce, is described as exceeding 13% and is covering all practical costs associated with physically transporting metal from New York or London to Shanghai, while still yielding a profit. The fact that this premium continued to widen throughout the session is presented as evidence that physical demand in Eastern markets was not waiting for Western paper prices to adjust. On the COMEX side, the registered silver inventory figure of 86,130,399 ounces is placed in historical context. The report states that registered COMEX silver holdings stood at over 200 million ounces as recently as September 2025, representing a decline of 57% over approximately 5.5 months. The average monthly rate of withdrawal during that period is cited as exceeding 20 million ounces. The report further notes that the eligible category of COMEX silver is also contracting, and that new metal is not flowing into the exchange at a rate sufficient to offset withdrawals. This inventory decline is occurring alongside unresolved March delivery obligations, where open interest is described as representing paper claims that exceed the volume of deliverable metal currently on hand. The report also addresses conditions in Shanghai Vault holdings, stating that combined Silver Futures Exchange and Shanghai Gold Exchange stocks are near decade lows, down approximately 90% since 2020 according to some reports, and currently below 25 million ounces in total. Regarding the CME Globex trading halt, the report states that the freeze occurred during the precise period when silver prices surged past the $91 level. During that window, 31,828 contracts were processed and settled, representing approximately 159 million notional ounces. Prices were subsequently pushed lower when trading resumed. The report presents this sequence of events as noteworthy given the simultaneous decline in registered physical inventories. Additionally, SLV, identified as the largest silver exchange-traded fund in the Western market, is reported to have traded at a 4.27% premium to its own net asset value during the volatility spike. The report explains that this condition causes authorized participants to create new fund shares while withdrawing physical silver, a mechanism it describes as contributing to accelerated COMEX inventory drainage when paper prices attempt to rise. The session's price movement was attributed by algorithmic trading systems to a stronger-than-expected producer price index report released that morning, as well as to fresh escalation in United States-Israel-Iran tensions, including reported strikes and elevated military positioning. Turning now to the broader structural picture that surrounds today's market activity. The report draws attention to what it describes as a sixth consecutive year of global silver market deficit, citing data from the Silver Institute. According to that data, industrial demand now accounts for 67% of total silver consumption, up from 47% a decade ago. Solar energy applications are identified as a particularly significant and growing source of that demand. The report also notes that global mine production peaked in 2016 and is not projected to return to those levels until 2030 at the earliest. Supply-side concerns are also highlighted in relation to Mexico, which the report identifies as the source of 45 to 50% of United States silver imports. The report notes that cartel escalation, road blockades, and mine security issues are currently affecting that supply corridor. It further references public statements by the Trump administration regarding potential direct United States military assistance against cartels in Mexico, describing this as a relevant consideration given the volume of silver production originating from that country. On the demand side, the report specifically calls out military and defense consumption as a factor that it says is not being fully reflected in current pricing. Silver is identified as a critical material in the production of missiles, torpedoes, electronics, next-generation weapons systems, data centers, solar panels, and electric vehicles. The report states that United States defense stockpiles were already drawn down to near zero levels in prior years, and that multiple ongoing conflicts are consuming silver-intensive components at scale. The report also addresses the options market, noting that implied volatility for silver on COMEX has risen back above 100 and is approaching the level of 134, a threshold last seen during a spike in January. This is presented as an indicator of market participants pricing in the potential for significant and disorderly price movements in either direction. In addition, the report references a recent regulatory action in China, stating that Chinese authorities have banned off-exchange rehypothecation and mandated physical delivery on derivatives contracts. The report characterizes this as the removal of a tool previously available for paper-based price management within Asian markets. Further context is provided regarding broader macroeconomic trends, including record-pace central bank gold accumulation, a reported 52% increase in Chinese gold exchange-traded fund holdings in recent months, public statements from Russia rejecting a return to a dollar-based system, and record gold and silver imports into India. The report is careful to present a counterbalancing set of considerations alongside this data. It notes that the East-West premium could narrow if Chinese demand moderates following the post-holiday period, or if additional Western supply enters the market. It acknowledges that the CME trading halt may have been the result of genuine technical stress, though it notes this represents the second significant metals trading disruption within a matter of weeks. The report further states that March delivery pressure could still be resolved through contract rollovers or cash settlement, that geopolitical tensions could ease and reduce safe haven demand, and that the SLV premium to net asset value could reverse if retail participation declines. High implied volatility, the report cautions, cuts in both directions, and a broader liquidity event elsewhere could trigger rapid downward price movement. To summarize the data points covered in this report, Western spot silver reached $93.80 intraday, while the Shanghai Gold Exchange benchmark closed at $105.34, producing an east-west premium of between $11.59 and $12.40 per ounce. COMEX registered silver inventories fell to 86,130,399 ounces, reflecting a 57% decline from September 2025 levels, with 2.3 million ounces withdrawn in the prior 48 hours alone. CME Globex experienced a trading freeze during a surge past $91, during which 159 million notional ounces were settled across 31,828 contracts. SLV traded at a 4.27% premium to net asset value. COMEX silver implied volatility rose above 100, approaching levels last recorded during January's spike. Shanghai combined vault holdings are reported near decade lows, below 25 million ounces. The Silver Institute data cited reflects a sixth consecutive year of global silver market deficit, with industrial demand representing 67% of total consumption. The underlying data referenced in this report, including CME daily stocks reports, Shanghai Gold Exchange benchmark prices, SLV premium and discount filings, delivery notices, and Silver Institute publications, are described as publicly available and continuously updated. This report has presented those figures as stated in the source material, without modification, addition, or editorial interpretation. As always, viewers are encouraged to consult the primary sources directly and to seek qualified professional guidance before making any financial decisions. This has been a financial education broadcast. That concludes today's Silver Market Report.